Well, good afternoon, everyone. Thank you for joining our webinar today. My pleasure to welcome you to the third and final of our three-part series on harvesting a profit. My name is Tom Cosgrove. I'm the Senior Vice President for Public Affairs and Knowledge Exchange, and I'll be introducing our speakers today and moderating our question and answers portion of the program. So with us today, we have our presenters, Chris Lawton and Caitlin McCullough, and we'll be joined later by two of our branch managers, Keith Stechschulte and Lynn Weaver, and Lynn is also the manager of our FarmStart program. Caitlin McCullough is a business consultant with our Auburn, Maine office, and Chris is our Director of Knowledge Exchange based here in Enfield. Before I hand it over to Chris and Caitlin, as I'd mentioned in introducing part 2 of this series, I want to thank the many supporting organizations that help publicize this webinar series. A number of these organizations have resources and programming for beginning farmers. So if you're looking for more information on beginning farm programs, those would be a good place to start. Some of them, in addition to, while we're covering financial topics here today, some of them have programs on technical and production practices and cultivation practices that may be helpful to you as you begin your farm operation. So with that, I'm going to turn it over to Chris and Caitlin.
Great, thanks, Tom. As Tom said, thank you to the supporting organizations who've helped promote this webinar series. And keep in mind that many of these partner organizations have training and technical assistance programs of their own. So we would encourage you, as Tom said, to look up the organizations in your areas to see what additional programs are offered. If you're a young and beginning farmer, you're not alone in the Northeast. So in today's session, we're going to cover funding your farm. The first topic we cover will be grant funding. Then we'll move on to financing. We'll talk about some of the things a lender typically looks for. That includes what we call the 5 C's of credit. We'll talk about some of the financing sources for farms. There may be more options than you think, including investment capital and debt credit. We'll have an interview with Keith Stechschulte, the branch manager of Farm Credit East Enfield, Connecticut office, and talk about farm financing. And we'll also interview Lynn Weaver, the manager of FarmStart, a unique funding option for beginning and growing farm businesses.
Great, let's get started. As Chris said, today's topic is funding your farm, which isn't always the easiest thing to do. Often, the first thing we think of is grants. The idea of free money is very appealing to most people, but sometimes the reality is a bit different, and it's a lot more difficult than you might realize. Let's look at why grants are offered, some examples of real grant opportunities, and some resources in your area.
I wanted to mention just before we begin that if you have any questions as we go through, be sure to type them into the questions feature on the GoToWebinar control panel on the right-hand side of your screen. They can be typed in at any point during our session, and they can be, we will go through them at the end of our seminar. So anyway, the reality is that there aren't any grants that just offer free money to start a business, at least not that we're aware of. Grant makers, like most people, usually want something for their money. Often this means that they are giving out grants that meet a public interest or achieve a public good. Examples include environmental improvements, renewable energy objectives, or job creations. Grants mainly fund projects, not general overhead. And keep in mind that applications that match projects with public interests are more likely to be successful.
Great. Grant makers and lenders are sometimes looking for the same things. Grants are the easiest for established, profitable businesses. You don't necessarily have to be a large business. In fact, most grants are targeted for small producers. But you do often have to show that you have some prior revenue. You need a solid business plan and a high likelihood of success. As Chris mentioned, grant makers want to see a return on their investment. However, it's not usually a financial return. They want to see some type of society benefit, energy savings, job creations, or some other metrics. It all depends on the grant.
In addition, there are some unique considerations that come with grants. Timing and funding cycles are critical and may not coincide with your needs. Most grants do not cover work already completed. Many require matching funds, and they can be a maze of funders, applications, and eligibility criteria. But we'll look at an example of some real grant opportunities.
Our first real grant opportunity is a federal grant. Now this grant is offered through the USDA's Rural Development Agency, and it's called the Rural Energy for America Program, or REAP. It provides loan guarantees and partial funding for renewable energy and energy efficiency improvements. REAP can fund 25% of eligible project costs, or up to a maximum of $500,000. And we've provided the website here at the bottom for you to check out later.
Here's another federal grant opportunity. This one is through the USDA Natural Resources Conservation Service, or NRCS as it's commonly known, and it's called the Environmental Quality Incentives Program, or EQIP. It provides financial and technical assistance to producers to address natural resource concerns and deliver environmental benefits. Application deadlines and funding levels vary by program. This grant contains their popular high tunnel or poly hoop house program that many small producers have taken advantage of. Because grant opportunities come and go, be sure to check with your local USDA Farm Services Agency office to see what programs you might be eligible for. The website for NRCS is on the screen at nrcs.usda.gov, and be sure to check out the USDA's New Farmers website, which is pretty good. It's www.newfarmers.usda.gov.
In addition to federal grants, some states offer some grant opportunities as well, and we're going to go through an example here from New York. This one's called the New Farmers Grant Fund, which provides support to beginning farmers. It will fund up to half the project cost for expanding or diversifying agricultural production from $15,000 to $50,000. And although it's called the New Farmers Grant Fund, it requires that you produce at least $10,000 in sales before you apply. Your state likely has additional grant opportunities, and you should check your Department of Agricultural website to see what might be available.
Thanks. So here are some resources that might be useful for farmers interested in grants. Farm Credit offers a grant writing service. For more information, contact Nathan Rogers at farmcrediteast.com. There are also a few good websites that list multiple grant opportunities. Two good ones are grantwatch.com and grants.gov. Check with the USDA Farm Services Agency office in your area to see what you might be eligible for. Check with your State Department of Agriculture to see what programs exist for new and beginning farmers. Additionally, some utilities and some foundations offer grants as well. Many utilities offer grants for energy saving improvements. Finally, there are foundations that offer grants as well and you can look into.
Now that concludes our grant portion, and now we're going to move on to financing and the idea of banks, credit, and debt, and what's available for businesses currently. Now, the idea might be a little scary for some of you, and for most businesses, including most farms, they'll eventually need some kind of financing. So our goal today is going to be to take some of the mystery out of farm financing, review the options available, and help you be more informed and prepared for when you eventually need to approach a lender. As you'll see, when we get through some of the details, this can be a complicated area, and there's often no hard and fast rules to achieving funding. Each lender is going to consider each applicant on his or her individual merits. But remember, you and the lender have a mutual interest in common. You want the money for your business, and they want you to succeed. Your goal should be to position yourself to make a yes decision an easy one. And that's going to be different for each funding source. But it's important to do your homework and tailor your information for each lender according to their priorities. A foundation might look at an application a little bit differently from a commercial bank, for an example. And I would really draw the similarity between this and preparing a cover letter or a resume for a job description. You wouldn't want to send the same cover letter to every job you ever applied to. You'd want to tailor it specifically to the job you're applying for and the company you're looking at. And lending applications are similar. So to begin, we're going to look at the most common kind of farm funding, debt capital or loans. For a lender, their main concerns are how are you going to repay the loan and what happens if you can't.
For most lenders, there are 5 main aspects of your application that they're going to consider. At Farm Credit East, we call these things the 5 C's of credit. They are character, capital, capacity, collateral, and conditions. Different lenders are going to weigh them each a little differently, but really all are important. We'll go through them each one at a time.
So the first C is character, and this really describes the individual who wants to borrow money and their track record with finances. In other words, the lender is asking, who are we lending to? Now here's a few questions that the lender would be thinking of. Does the borrower have a history of paying loans on time? Does the borrower have a history of making profits in their business? And if so, does the business have a good track record? Does the borrower have an expertise and experience to make this business a success? If it's questionable, do they have an advisory team in place to help them go through the rough spots? Do they have enough thought through this venture? Do they have enough merit to stick with it when things get tough? Now, credit scores generally play a really big important role here. Your credit score encompasses more than just your track record. It takes into account things like existing debt levels and your record of payments on time. Your debt obligations are going to be a big part of it. Now, this is also similar to your SAT score when applying to colleges. It's a quick and easy way for them to look at, what you are as an individual in terms of financial picture. Now, of course, the sum of your character is more than your credit score number, but it's the easiest and fastest way for a lender to get a snapshot of what your financial history looks like. Now, because your credit score is going to be so important, it's crucial to make sure it's accurate. Everyone is entitled to one free copy of their credit report each year, and you can go to www.annualcreditreport.com to access your reports from the 3 major credit bureaus. You need to verify if this information is accurate, and if not, you should file a dispute with the credit bureau. Note that information may stay on your credit report for a long time, and if accurate, it can be tough to get negative information removed. So be sure to protect your credit score by managing your finances well and making your payments on time.
Thanks. The next C is capital. Capital is another term for net worth, or how much money you have access to. Your net worth is how much you own versus how much you owe. This is where your balance sheet, which we talked about in the first Harvesting a Profit session, comes in. You should have up-to-date balance sheets both for yourself as well as for your farm if they are separate entities. Solvency is the state of owning more than you owe, or positive net worth. Leverage is the percent of assets financed by creditors, as shown by the debt-to-equity ratio. Debt-to-equity is the opposite of the measure of net worth. So a 74% debt-to-equity means someone is highly leveraged. They only have 26% net worth. In other words, most of their assets are financed by creditors. A 25% debt-to-equity ratio shows much greater solvency. Only 25% of their assets are financed by creditors. It's very difficult to finance someone who has negative net worth.
The third C is an extremely important one. It's capacity. Now, capacity is an individual or a company's ability to repay the debt, or to put it another way, their ability to cash flow their debt obligations. This is where the statement of cash flows that we talked about in session 1 comes in. And we've provided an example here of a cash flow budget. This farm has $800 in cash sales, $450 in cash expenses, which leaves $350 in debt service capacity. The loan payment is $120, leaving a cash surplus of $230. If the debt service exceeded the cash generated by the business, that would spell a lot of trouble for the business and for the lender potentially. Capacity is critical for both the borrower and the lender. You may have a great credit score, good net worth, and positive attributes, but if your enterprise doesn't look like it's going to be able to generate enough cash on a regular basis to make the loan payment, then you should not take the loan, nor should the lender lend it to you. Many people approach lenders thinking they should get the loan because they need the money or because they have that collateral to back it with. But if you haven't thought about the cash flow and how you're going to pay the loan back, you're going to struggle with repayment.
Thanks. The fourth C is collateral. Collateral is the plan B for a lender, and that's important to consider. It's the plan B, not the plan A. So for some lenders, like Farm Credit East, for example, collateral is not the most important one of the C's, because ultimately that's the fallback position of the bank. So it's important, but it's not the primary consideration. Capacity would be. But there are generally two kinds of debt, secured and unsecured. Secured means it has collateral attached to it. Unsecured means it does not. For example, a mortgage is a form of secured debt, generally by real estate. An example of unsecured debt is most credit cards. Unsecured debt generally comes with higher interest rates because it's more risky for the lender. One thing to keep in mind is that when valuing collateral, the lender has to figure out the net recovery value. This is generally substantially lower than its fair market value. Just because you paid $250,000 for a home doesn't mean that's its net recovery value. The lender has to consider that in a foreclosure, it will be a distressed sale, often at auction. Thus, few lenders are willing to extend credit for the full fair market value of assets. Another phenomenon to consider is that of lost capital. Lost capital is the difference between money invested in an asset and its recovery value. A highly improved and specialized property, such as a new dairy milking parlor or a greenhouse, usually has substantial lost capital. This means that an average buyer of the property is not likely to place the same value on those improvements as you have. Often specialized properties are sold for no more than their unimproved real estate value because the next buyer does not plan to use the property in the same way. So try not to be offended if a lender doesn't assign a large collateral value to an improvement you paid a lot for. That doesn't mean it's a poor investment for your business. It may still help your business substantially and contribute to profitability, but it does mean that the ability of the lender to recover the cost of it is limited. Usually the more specialized the investment, the greater the lost capital, because there are a more limited number of buyers who would want them.
Right. The last C is conditions. Conditions are terms under which the loan is written. These include things like your interest rate, the term or length of the loan, repayment rate, etc. Other conditions that can also be used are known as covenants, and they may apply as well for your loan. For example, these often include a requirement that property taxes be paid, or that adequate insurance can be maintained on structures used as collateral. Regarding the term of the loan, it may be tempting to push out the repayment term as long as possible to lower your payments, but try to keep loan terms shorter than the asset's useful life. For example, on a car, you should try to keep the term to 5 years or less. Otherwise, you might find yourself with a worn-out vehicle that needs replacement and a loan that is still not paid off. If you can't cash flow the payments with terms shorter than the useful life of the asset, that's a sign that it may not be a good investment. Insurance is a very common covenant for many loans. Remember that even if there's an accident, you'll still be required to pay back a loan. Other conditions could include maintaining a positive financial picture, using ratios or some other measure, or limited additional borrowing. A lender may require these in order to manage the risk of your loan.
So when it comes to loans, you have a lot of options. One option, of course, is the Farm Credit System, which is represented in this area by Farm Credit East. Farm Credit East, as with all farm credit associations, is a farmer-owned cooperative focused on lending to farming, fishing, and forestry. Our business model allows us to offer competitive rates to farmers, as well as to return a portion of our earnings to our members, which could further reduce your net cost of borrowing. Farm Credit East also offers a full suite of financial services, including record keeping, tax preparation, consulting, and payroll. Finally, there are special programs for young, beginning, small, and returning veteran farmers that may help borrowers in those categories. Another important option is the USDA Farm Service Agency. FSA offers multiple lending programs for all types of farms, including small and beginning farmers. Loan limits vary from $50,000 for their microloan program to well over $1 million for some of their other programs. Sometimes they are able to offer capital at very low rates, but budgets can limit their lending ability. FSA programs can be complicated and substantial paperwork may be required, but it's an important option to consider. It's also important to note that there is a hybrid between Farm Credit East financing and FSA loans. This is the FSA guaranteed farm credit loan. For some borrowers, it makes sense to get an FSA guarantee on their Farm Credit East loan. This can result in a lower interest rate because it's less risky for farm credit, and it may allow some deals to happen that would otherwise not be possible. Next, we would be remiss if we did not mention commercial banks. Banks, both local and national, finance farms as well, of course. An advantage that banks have is that they may offer additional banking services, such as checking accounts, credit card processing, cash management, and more. In today's competitive market, the rates offered by banks can be comparable to other options. It should be noted that their interest in agriculture varies. They may not understand your business or the unique needs of agriculture and could be wary of the risks involved, but they are certainly part of the funding landscape. They do finance a number of farm businesses and are certainly an option to consider. Since we're on the topic of commercial banks, I should make a special note here about credit cards. I think most business advisors would agree that this is probably the worst option for financing a fledgling business. People do it, and that's why I mention it, but interest rates can be very high. It's easy to get sucked into a pattern of being only able to make minimum payments, and you can seriously damage your credit rating by getting strung out on major credit card debt. They're convenient, and many business owners can't live without them, but relying on them to finance your business can be dangerous. Next, there are some nonprofit organizations out there that provide financing. One example is called the Carrot Project. The Carrot Project is a nonprofit organization which administers several programs that make loans to small and mid-sized farmers in several states. They are just one example, and there are other organizations out there with similar missions. Possible shortcomings can be that funding is sometimes limited, and they may have specific criteria they are looking for in borrowers, whether it's the characteristics of the individual they're lending to, your geographic area, or the type of farm that they want to lend to. But if you are able to align with the goals and criteria of a nonprofit lender, they may say yes when others say no. Finally, the seller of a piece of property or a business can be a source of financing. It's not unusual for the seller of a farm to hold the paper on the farm for the buyer to pay off over time. This can have advantages to both buyer and seller. For the buyer, sometimes it's the only way to make a deal happen. For the seller, it can provide reliable, stable income to meet retirement needs or other life goals. But it's important to be cautious. It's a good idea to have a formal agreement in writing, reviewed by an attorney, to make sure there are no surprises on either side. Many of these types of deals fall apart if the goals or circumstances of one party changes over time and there is not a legal agreement in place. You may need to explore multiple options to see what works best for you, or sometimes just to get funded. If you are denied by one or more lenders, consider it a learning opportunity. What did they see that you didn't? Sometimes entrepreneurs can be overly optimistic about their business. It may hurt to be told no, but sometimes being denied a loan may be the best thing that could happen and could prevent you from getting over your head in debt. Being denied a loan can be an opportunity to reevaluate your circumstances and see if perhaps something needs to change for a loan to make sense.
Now, we just went over some of the debt capital options, but sometimes debt capital isn't the best option, particularly for a beginning farmer. A lot of people try to obtain debt capital when what they really need is an equity investment. Debt capital is often largely collateral-based, as we discussed, and given only after the enterprise has started to show profits. And many times lenders are risk-averse. You're unlikely to walk into a bank with a business plan and a dream and walk out with a loan. But you may be able to find an investor to help fund your dream. That's why many businesses tap investors or equity capital as a source of financing, particularly in the early stages of development. Some pluses to equity investors are that they have a much greater risk appetite than a lender. They also may be able to finance at an earlier stage than a lender, either pre-revenue or pre-profitability. However, there are some cautions you should think about. It may dilute your ownership. They may want to take an ownership stake in your business, which means now you'll have a partner in your business. This can be good if they bring expertise or advice, but that also means you may no longer have free rein and do as you want to with the business. A mission-driven investor may want to direct your farm, for example, and it could be attached to your funding. Sometimes an investor may expect a greater return than what your enterprise can support. Or, if you're more profitable than expected, you'll likely have to share those profits with your investors as well. Another caution is that sometimes your timeframes don't always align. You may be in it for the long haul, but they might have an exit strategy after only a few years. Many of you have probably seen the reality TV show Shark Tank, which focuses around this type of proposition. If any of you have seen the show, you know that not every deal offered may bring you the deal of your dreams. It may have strings attached or a different structure than you were anticipating, and it's important to weigh the benefits against those costs.
Thanks. One type of investment capital is a spin-out from Farm Credit East called FarmStart. FarmStart is a partnership of Farm Credit East, Yankee Farm Credit, and CoBank, and it was created to invest in promising startups in farming, fishing, and forestry. FarmStart invests up to $50,000 in new or growing farm businesses. The farmers have up to 5 years to pay it back or roll it into a conventional loan. The money is generally unsecured and can be used for things like operating capital, startup money, or expansion capital. With the investment comes a FarmStart advisor, and the participant is expected to meet with that advisor several times per year to review progress, discuss strategy, and sometimes change strategy as circumstances warrant. The program is now in its 10th year, and over 160 investments have been made to date.
Next, we're going to go through a few other options for funding. Another source of equity funds are known as angel investors. When we think of a venture capital, we often think of some hotshot investor looking for the next Uber or Google, the kinds of people that pour money into fledgling startups, and small farms are generally not lucrative enough or scalable enough to attract that kind of venture capital. However, as we've mentioned, mission-driven investors are out there who do want to invest in small farms and the food system. One example of this type of group surrounds the concept of slow money. These organizations that provide financing to entrepreneurs who align with their vision of what they feel like the food system should look like. Certainly not all farmers will fit their investment criteria, but for those that do, this can be an important source of funds, particularly in the early stages of development. Some other examples of funding also include micro-lending in the form of investment groups or individuals, which feature small dollar amounts and flexible terms, or crowdfunding, which is generating usually a modest dollar amount from a large number of individuals. There are a lot of organizations and individuals in this funding space, and more are developing over time. It may not be right for everyone, but if you can find someone who aligns with your goals, it might be the right spot for you.
Thanks. Next, we have some additional financing considerations. One is don't borrow your last dollar. If you're going to build a barn and you're able to borrow $50,000, don't embark on a $50,000 project. Leave room for contingency. What if you run over budget? What are you going to do with a half-built barn? A lender may not extend your line of credit just so you can finish the job. If you're budgeting for a greenhouse, what if it rains Memorial Day weekend? Will you still be able to make your payments? Remember Murphy's Law. If anything can go wrong, it will. Having some reserve funding available is a prudent move. Don't max things out. Look for your funder's commitment to agriculture. A funder that's committed to agriculture is likely to be more understanding if things don't go quite as planned. They're more likely to understand your business and your needs. Don't shop on cost alone. Costs and rates are important, and it's something you should definitely consider. But look at the whole package, the terms, the company or people you'll be dealing with, and their commitment to you. Finally, be realistic. As we said, sometimes getting turned down is the best thing that could happen. Maybe your first shot wasn't meant to be. Don't take that as permanent. It may just mean that you need to rethink your strategy or come back at a later stage of development of your business. Some funders are geared towards early stage businesses, some are geared towards established companies. And when you're working on budgets and projections, be conservative. The consuming public may not be quite as enthusiastic about your new farm as you are. Doubling your sales might not really be realistic. What if things don't go as you hope? Starting and growing a farm business is already challenging and risky. Don't burden yourself further with unrealistic budgets. And don't hesitate to revisit those plans and budgets as things unfold. It's not unusual for a young business to have to change strategies in their early years. So the next part of our session is an interview with Keith Stechschulte, Branch Office Manager for Farm Credit East Enfield office. Keith grew up on a farm in Ohio and has been working in lending for Farm Credit since 1993. Welcome, Keith.
Well, thanks, Chris. Glad to be here.
So, Keith, you've been involved in farm lending for a long time. What are some of the first things a farmer should or a prospective farmer should consider when looking for financing?
Yeah, the previous slide, Chris, was a good. That's a good baseline for customers to and prospects to be thinking about. But just to add on to some of that, first, have a solid business plan. I mean, understand the market that you're getting into. Know the key risks, be it the financial risks, the production risks, the seasonality risks. also really have a good handle on the industry returns. And often, and you mentioned in that previous slide, often we see business plans, and I think the expected returns are over-optimistic.
Great, thanks. What are some of the biggest challenges that you see young, beginning, and small farmers facing when trying to obtain funding?
Key challenges, and it's the nature of the industry, agriculture is a very capital-intensive industry, and often new applicants, especially young and startup farmers, they often lack the overall financial strength to probably fund all their needs. Second, all too often they lack a credit history, especially younger farmers that are starting up. Either they have no credit history, which is actually probably less of a problem than those that ran into some credit problems previously. That tends to be a bigger challenge. Another challenge is going in with maybe the wrong expectations and expecting a lender to 100% finance your plan, and that typically doesn't happen. Typically, you need to have a down payment and need to have you can be in a situation where it's really easy to over leverage, and we try hard to avoid that.
Great. So, do you have any advice on how to overcome some of those specific challenges?
Yeah, first and foremost, even just when you're starting out, make sure you're paying all your bills timely, and that's key. Look for opportunities to find a mentor. That could be a farmer who's close to retirement. Earlier in one of the slides, it was mentioned their state organizations, or even the Department of Agriculture in various states have programs to try to link retiring farmers or near retirement farmers with young farmers. That can be very beneficial. Really take a hard look at your plan and say, especially if a lender thought you're being too aggressive, can I do this in stages? Is there ways I can limit some of my that risk and that leverage exposure so I can better manage that? Another thing is there someone else that can help? If you're good on, say, you're looking at those 5 C's of credit, which we look at, on every application, and maybe the returns are there, your credit history is good, and you're just over leveraged, and so the capital component of those 5 C's isn't where you want it to be. Maybe you can get a guarantor or somebody like that to help. And also talk to your lender. There's tools available like the Farm Service Agency, their guaranteed loan program. I mean, that's something we use regularly and often with startup farms and new farms. I mean, that's a tool that helps mitigate some of those risks. It's a great tool, especially for the C involving capital to mitigate that.
Great. What are some common mistakes people make when trying to get a loan?
And you've touched on some of these already earlier, but first and foremost, automatically going to the longest term and not matching the loan request or the repayment terms with the life of the asset. All too often, they'll want to have a loan and automatically want to go 10, 15, 20, some fairly long terms, which may not make sense for the life of the asset and really for the type of business that you may be starting. Secondly, and I touched on this before, is they want 100% financing, and that's typically not what banks do. I mean, if you're looking for that type of an investment, that's more on the equity side of the scale and not on the debt capital side. And I touched on this before, but don't overestimate your returns. That's a very common mistake. And also, and Chris mentioned this earlier, is make sure you're considering lost capital or real depreciation in the asset, because it is very likely, especially if you're getting into a more specialized type of asset, that what you paid for it and what I turn around and value it for could be two very different things. And that difference is called lost capital, and that's something you really should discuss with your lender.
Great. Are there any tips you could give to a first-time borrower?
Sure. One, and we've really touched on these already, is pay timely. Second is really understand those 5 C's of credit and what they mean for your business. And really the foremost to focus on would be the capital capacity, collateral, and the character C. And And that goes back to repayment history, really knowing that solid plan. And the other thing I would say is go talk to your lender early on. Don't be afraid to ask for help. I mean, I'll speak for Farm Credit because that's where my professional career has been based. Is we have a lot of individuals and programs here that are designed to help the startup farmers. So don't hesitate to ask.
So even if you're not necessarily ready to borrow money or apply for a loan at that time, it's okay to give you a call and just maybe come in and talk about your ideas.
Certainly. Loan officers like to do that. The one thing that is you'll find here, I think that any of the Farm Credit East offices you go to and talk to the credit staff or consulting staff or our financial services staff is we're all very passionate about young farmers and helping them succeed. So I think if you call to make appointments and I just want to go over some ideas, you'd get a very welcome response.
Good. Are there certain characteristics or traits you look for when considering a funding request?
Certainly. How much are we being asked to finance? What's the percent of the total project? So how large is the down payment, said a different way? Secondly, what type of financial flexibility is being retained? Is the applicant asking to borrow their last dollar? And you touched on that earlier, Chris, and that's very key. How well do they understand the industry and the business? And that's where a good, solid business plan, especially if it's a startup venture, helps. If you don't have any production history, actual history, in your resume. And finally, and it sounds like a broken record here, but past repayment history with others is going to be is very key.
Good. How important is off-farm income to the credit decision?
I mean, it can be important. It's not an automatic requirement by any stretch, but it can be the stabilizing force needed to help during those off-season months, or if it's a startup operation, that off-season month, off-farm income rather, can help carry some of those costs you're incurring and some of those overhead expenses until the farm business turns cash flow positive. Great.
Does the type of farm business or how someone decides to farm matter to the funding decision?
It does not. We have a very diverse loan portfolio, and we actually look for all types of lending opportunities: large farms, small farms. The type of farm does not play a significant factor as long as it's a legal type of business that you're doing.
Okay, great. So those are a lot of good questions and answers there, Keith. Do you have any other thoughts or comments for young, beginning, small, and returning veteran farmers in the audience?
Don't be afraid to reach out to existing farmers that are in the the type of agriculture you want to pursue. I think that's a great resource that often goes untapped and can really could probably be a great mentorship to a startup farm.
Great, thanks, Keith. So thanks, Keith, for the great information. Go ahead, Caitlin.
Oh, I was going to say, Keith, are you going to stay on the line in case anyone has some questions for you?
Yes, I will.
Okay, great. So that was a lot of great information. Next, we're going to interview Lynn Weaver from FarmStart. Lynn Weaver grew up on a dairy farm in Pennsylvania and has been working with Farm Credit longer than he cares to remember. Since 2012, he's headed up the FarmStart program, a unique investment program for beginning and small farmers. Welcome, Lynn.
Well, thanks. It's great to be here.
Great. So we're going to jump right into, why don't you tell us a little bit about FarmStart?
Well, FarmStart's an investment program. As you saw on some of those earlier slides, there's the debt capital and then also the equity side. This would be more on the equity side. It was started by several farm credits that have come together, and we really are trying to provide financing for those young farmers and to finance the items that really aren't able to be financed by maybe another traditional type of means. Whenever we think of that, we think of operating money, which is typically pretty difficult to get financed elsewhere, or non-traditional types of capital items, greenhouses, some unique other types of equipment, buildings. So we're trying to help the young farmers be successful and develop some really good financial habits.
Great. And to follow that up, what specifically is different about FarmStart compared to other means of funding?
Well, one of the primary differences between FarmStart and some of the other financing options is that FarmStart comes with an advisor. So we have somebody that will be working from the beginning right straight through the 5 years of the length of that investment, trying to work with that customer and help them develop some really good financial discipline, some financial habits. And there are other, as you saw on the previous slides, there are other places where there is financing available, but I'm not aware of other places where you can get someone who'll come beside you, give you advice, and really take that interest in your business to help you be successful.
And can a participant combine FarmStart with other means of financing?
Very definitely. We have FarmStart investments with farmers who have other loans. They may have a loan with a more traditional lender. They may have gotten some grants from some other, either USDA or some other place. And sometimes we do joint loans with our own Farm Credit East as well as farm service agencies. So there are a lot of opportunities, and we've seen where putting a package together, an investment package together, has worked well for the customer.
Great. Maybe you could discuss what kinds of businesses FarmStart has helped.
Well, the intent is really to work with those younger businesses that are getting started, or maybe a business that's going through an expansion. We've done the traditional dairy, grain, vegetable, which might be considered more of the traditional type of farm businesses, but also grapes, CSAs, mushrooms, hops, shrimp. We've really done a wide variety, and if it's farming used to be thought of as being out in the fields, but we've done financing for businesses that are really more in warehouses as well.
Very cool. Now, a couple of times we've mentioned that starting a new business can be very risky, including farms and other businesses alike. Can you describe what FarmStart's success rate is?
Well, you know, you say that about businesses getting started, and I think the statistic is about half of the businesses ag businesses that start are successful, which also means the other half are not successful after about 4 or 5 years in business. What we've seen with FarmStart is we have a success rate of the high 80s, close to 90%, and we're really proud of that success rate. We think that there's really some real benefit of working with your FarmStart advisor.
Now, is that what you would attribute the biggest difference to?
Well, we think that hopefully we're working with the right customers, that those that are coming to FarmStart have really done their homework. But really the other big key that we see is being able to work with an advisor and having someone else who has some financial background, who has an interest in making sure that your business is successful, really helps you be more successful as well.
Great, thank you. What advice do you have for beginning farmers seeking funding?
Well, I think one of the biggest advices, and some of this may be repeat from what you've heard earlier, but you really want to make sure that you do your homework, get some practical advice and practical experience. That experience may be had by working on a farm, doing a similar type of production that you're looking to start up yourself. It may be making sure that you keep your credit report clean. One of the items that we see is the credit report and how important that is. Pay your bills. Develop those habits, whether you're in the business or not in the business, but develop those financial habits that include paying your bills timely. That's a real key. Developing a realistic business plan is crucial, and making sure that you have that team, that develop a team of professionals and of family members or friends that are going to be there, that are willing to help come beside you and help you be successful.
Great, that sounds like some great advice, both financial and non. Do you have any closing thoughts that you want to leave with our group?
Well, you know, as far as closing thoughts, you're starting a young business, you're starting a new business, and you're asking for someone to make an investment into that business. And the real key is whenever you're asking someone to make that investment, you're really asking them in some ways to partner with you in the dream that you have. And a real key, anytime you're in a new business or in a partnership working with somebody, is communication. A real key that we see for people that are successful is being willing to communicate with those other parties that are involved in their business, coming into it with the right attitude, and being willing to accept advice from other people is another real key as you're trying to get started. Be a life learner. Make sure that you're willing to continue to learn, both as you start the business, as you continue the business, and keep that team, as I mentioned earlier. Just make sure that that team is that you have working with you is there to help you. There are going to be days whenever things don't go as well as you thought they would, and to have a team beside you that's able to support you up and help you whenever you're not feeling as good about your business as you might have whenever you started day one. It's really important to have that team there beside you.
Well, great, Lynn. Thank you very much. And will you remain on the line for questions at the end?
Yes, I will.
Great. Thank you.
Great.
I'll turn it back over to Chris.
Thank you very much, Lynn. Thanks very much, Lynn.
You're welcome.
For those of you who would like more in-depth management training, our Generation Next program is designed to take existing managers to the next level. It's ideal for young farmers who have some management expertise or training already and who would like to identify areas for personal growth and development, gain tools they can use in their business, and have the opportunity to network with other young leaders in agriculture. It takes place over 3 full-day sessions in person with a Farm Credit consultant and trainer. Contact us for more information.
So we've covered a lot today. We looked at grants, organizations that offer them, and some examples. We talked about the 5 C's of credit, which are character, capital, capacity, collateral, and conditions, and why each of them are important for the lender and the borrower to think about. We looked at 2 main types of funding, equity investment and debt capital, how they're different, and gave some examples of each. And we finished by interviewing 2 of our experienced farm funders to get their advice for small and beginning farmers.
Great, thanks, Caitlin. Now we're going to go to some questions and answers.
Great, thanks, Chris, Caitlin, Lynn, and Keith. Excellent presentation. So just a quick reminder: if you have a question on the side panel of your go to webinar, you can type in a question, and I'll field those and put those out to our speakers. I also want to just a reminder that we are recording this webinar, and like all webinars, those will be available at farmcrediteast.com/webinars. So while we got some questions on their way in, maybe I'll kick it off here. A question for Keith. Keith, when you talked about one strategy might be phasing in an operation, are you talking about, say, I don't know, maybe renting a farm before you buy the farm, or maybe you could say a little bit more about how that might work as you're trying to fund your new business?
Certainly, and what you just said would be potentially one option if you is to limit maybe some of your leverage. Is there a way to lease a farm for a while till you build up kind of the operating history and the profitability to make the debt associated with the land purchase more affordable? But even before you get to that stage, for a small startup operation where they're financing maybe some production equipment, potentially some delivery equipment, and maybe some working capital needs as well, is, you know, obviously the production equipment is going to be pretty key, but you know, the delivery side of it, you know, could you do a short-term rental for the trucks, especially if it's more of a seasonal type business where these things might be sitting in a barn or unused for several months out of the year? Can you stage it in that way? And in addition to you know, just looking at your revenue stream, can we grow that a little? Can we grow that a little slower and keep expenses down to limit leverage that way too? So that was kind of the intent of the phasing in or stair-step approach.
Great, great. Maybe I'll pitch one out to Lynn here while he's still on the phone. Lynn, you mentioned that the FarmStart program has financed a kind of a pretty broad variety of ag businesses. Am I correct in saying that actually would co-ops potentially be in groups of farmers be eligible for funding under FarmStart as well?
Good question. I didn't specifically answer that. The answer is yes. And we have worked with co-ops. We have a FarmStart investment with co-ops right now. So in groups of farmers coming together. They may join under a co-op or some other LLC entity or whatnot. But yes, yeah, we can finance and help any farming businesses they're trying to get started.
Okay. One back to Keith here. So, and you guys kind of touched on this in a couple of different ways, but you know, if ultimately the answer is no, the request comes in. I mean, I guess what I'm hearing is that, you know, it's not just going to be no, but there'll be some explanation with that. You know, kind of what's the next step for the beginning farmer?
That's a good question. And, you know, it does happen where that answer is no. However, one thing we always try to do is it isn't just say no and see you later. It's, you know, what are our options? You know, can we look at this business and say, you know, going back to my earlier comments, can we stage it a little differently? Are there some other resources available? You know, Farm Credit East may have had to say no based on certain credit underwriting factors, but maybe Farm Service Agency is an option, or maybe an FSA guarantee is an option, you know, to go back and relook at it that way. So we always, you know, if and where we can, Tom, we always try to have a, you know, have an option or two if we can't do it directly.
Okay. I would have a question from the audience here. So, and I guess I'll let Chris and Keith take it first, and then maybe we'll put it up to Caitlin and Lynn. So the question is that, as has been discussed, that debt lenders will usually only fund a certain portion of the required investment, say 80%. You know, what are some of the options for that remaining 20%? Is it possible for them to take out additional loans, or if someone did try to fund that say the remaining 20% through a different loan, you know, how would the lender view that?
You want me to take that, Chris?
Sure.
That is an option. However, that's really going to depend upon your overall financial position, because you are still at that point 100% financing that asset or that acquisition. And I will tell you, you know, most banks won't look at that very favorably. A key to that, though, is going to be like, well, what's my overall net worth? How much, for lack of a better term, how much skin do I have in the game individually? And if you, you know, if it's a startup and you're borrowing 80% from Farm Credit East and 20% from somewhere else, and you have none of your own money invested in this at all, that's probably not something a business is going to look at favorably.
Yeah, I would agree with Keith. I'm not saying it's necessarily a satisfying answer, but it's a tough nut to crack. If you don't have anything to put into it of your own, or some kind of gift from a, you know, friend or relative, or investment from some other type of investment capital, it's tough. If you're going to finance 100%, even if it's not 100% from the same person, it's still going to be looked at as 100% leveraged.
Yeah, the only other thing I would add, and we have done this in the past, and again, this really becomes very deal dependent, and the quality of the business plan is, you know, if they've gone to a state grant for part of the down payment, you know, and those typically are come in on the back end, and, you know, where they've asked Farm Credit East to bridge those grants. We have done that, but that's very much a case-by-case basis, and you know, those decisions are going to really be based on that individual deal, where you are. We want to know kind of and have it fairly definitive in writing that grant is locked up, and as best we can, and know that money's going to be there, you know, when the project is completed.
Hey, why don't I just turn it to Lynn or Caitlin? Anything you want to add on that one? I think we're towards the end of our hour here, so we'll probably wrap it up here. But anything you guys want to add?
The only thing I wanted to add maybe is maybe one of the lenders could provide some discussion on cross-collateralization, if that's an option for people.
Lynn, you want to take that?
Sure. I mean, there are times whenever you know, in regards to minimal down payment, FarmStart can help bridge some of that. Again, it's going to go back to your business plan and the cash flow that you developed, and making sure that you've looked at the credit needs, the cash flow needs that you're going to have, because you're effectively taking on more debt then. And so by not having the down payment, it really does make it a little more challenging. Cross-collateralization, though, there are times whenever some collateral can be used for more than one loan, and FarmStart will do that, being that we would at FarmStart would take a what would be considered a junior position behind a primary lender on typically personal property type of collateral.
Thanks, Lynn.
Okay. Well, great. Appreciate that. Well, I think, again, we're at the end of the hour. I think I'll turn it to Chris and Caitlin to wrap it up.
Yeah, thanks. There's a couple of questions that have come in about the recording and the slides. I just wanted to mention that both will be posted by probably tomorrow morning on farmcrediteast.com/webinars. All of our current and future webinars live at that address.
So, you know, one last question came in. It's a real good one. So I'm going to break form here, and while we got Keith here, working with a crop like hops, and this could apply to a few others, where there's sort of that time before, that pre-productive time. Mm-hmm. How do we look at that?
We do, and actually we have experience with that with a lot of the crops in our office, or with some of the crops. And what we do is you look at the length of time that the crop's planted and when it's going to turn revenue positive, and we wouldn't structure any principal payments until you're generating revenue. So typically there'd be interest-only payments. Quarterly is very common that you'd be required to pay on the balance outstanding on that loan, but we would structure the repayment of the loan tied to when your income starts coming in from that crop and investment.
And that's obviously a key thing in terms of sort of understanding the industry and understanding that, all right, this particular crop or commodity is not going to be available for a year or two.
Correct. Yeah, and that's one of the benefits. I'll toot Farm Credit's horn a little bit here is the fact that we understand agriculture, we understand the seasonality, and we structure loan repayment based on the seasonality of your business, and not just on a monthly, where you got to pay principal and interest monthly, depending, and with no thought of when your income stream is coming in.
Okay, good. Well, that was a good question, so I wanted to take that before we wrap up. Now I will turn it over to Chris for that part.
Sure. I just want to, before we wrap up, I want to put in another plug for our supporting organizations and encouraging you to reach out to them for more resources and information. As I mentioned at the beginning, if you're a young and beginning farmer in the Northeast, you are not alone. There are a lot of organizations out there supporting new farmers in the Northeast, and the list that you see here is just a few of them. Next, I will mention our future webinars. The Harvesting a Profit webinar series ends with this session, but our webinar series goes on. If you're in the fruit or vegetable sector, you'll probably want to tune into our Food Safety Modernization Act webinar coming up on December 3rd. The final rules have just been released, and we'll have Wesley Klein from Rutgers reviewing them. As always, as I mentioned, registration and recordings for our webinars are at farmcrediteast.com/webinars. And your questions and comments are welcome. If there was anything we didn't address in the session today that you think we should have, or you have follow-up questions, feel free to email myself or Caitlin at the email addresses on the screen. So with that, I will thank you for attending, and we will wrap up.